before I start, just as a little get to know the audience, can I ask how many FT readers I have here today? Okay, lots, brilliant. Money Week readers? Money Week readers for more than 5 years? Wow, okay, you're nearly my favorites. Any Money Week readers for more than 10 years? 1, 2, 3, fantastic, thank you. Can I have the Money Week readers who've been with us for 10 years move up to the front into the expensive seats? Is that okay, Sven? Up to the front, come on, let's get close. No? Okay, well maybe you won't be with us another 10 years. Okay, well I've got a few things I want to talk about today, but I want to start by talking a little bit about sex. You know, 99.9% of the sex in the UK does not result in the birth of a baby. And that's not because people are doing it wrong. Now I want you to keep that thought in your head for the moment, the clean bits of it anyway, and we're going to come back to it. It's very, very important. Before I talk about the sex bit, I want to talk a little bit about beliefs. Everybody holds a few completely bonkers things in their heads, but very recently I think we've been finding out quite how bonkers those things really are. I've been looking, as Money Week readers may know, at a 2011 study from the University of Cardiff that has outlined the madness of the things that most of you already believe. There are 10 beliefs held in the heads of the UK population which are delusional, and 90% of people hold them to one degree or another. So I want to look at a few of those. First one, certain people are out to harm or discredit you. 33% of the UK genuinely believe that. Anyone here believe that? Yep. Only 3 SNP voters in the audience then. Next one. Your thoughts are not fully under your control. Anyone? Okay, more SNP voters than I thought. You are an exceptionally gifted person that others do not recognize. That's 40%. Okay, you, Alex Salmond, and Nigel. Nigel, you still here? No? Now, I feel like that around my kids, but otherwise not, because it is mad. So you get the idea. According to the academics, the vast majority of us are absolutely bonkers. Now, until this election, I would have believed that this was nonsense. People are just not that silly. Then this election campaign started, and then I got through my door this. Whoops, not that one. This one. This is from Deirdre, who is my local SNP candidate in Scotland. Deirdre is well-meaning, although clearly not 100% in control of her own thoughts. According to Deirdre, the SNP is the only party with a plan to invest in public services to end the need for austerity cuts. Read down a bit, if you can. I'm afraid slides aren't my #1 skill, but if you can read down a little bit, you will see that the idea here is that increases in UK public spending will allow the deficit to be cut. Now, I have no idea what this means. I have no idea what Deirdre is talking about. She wants me to vote for her. I don't know what she means. The only way to cut public spending would be to cut public spending. And of course, you don't invest in public spending, you spend on public spending. And spending on public services doesn't end the need for UK public spending to fall, it just makes the need for it to rise later larger. So this is absolute nonsense. The only way that a rise in public spending could bring us a cut in the deficit would be if it led to stunningly fast economic growth. Now, some people believe this. This is delusion number 4. Anybody believe this? 1. Okay. 2 people, 3 people are with Deirdre. Excellent. Now, given that the state already spends some 45% of GDP in the UK, given that national debt has soared under this government, and given that we haven't really grown at all, I think it's very, very unlikely. So who would vote for somebody who believes this? Who would vote for something this delusional? Some 40% of Scotland. And we know, of course, that these delusions are not just specific to Scotland, because Ed Miliband's policy is remarkably similar. Another 90 billion or so added to debt over the next decade, and the Tory manifesto doesn't show anything particularly different. So very delusional. Now, it's not a new delusional. This is from 1963, from one of our archives, a magazine called The Statist, which is absolutely wonderful. It's defunct now, but flick through it and you find that nothing has changed. Vote now, pay later. That's what they said then, that's what they're saying today, and it is, of course, exactly what's going to happen, because we are really, really going to pay. Right, on to the sex. Who's still got that image in their head? An awful lot of liars in this audience. We haven't been having enough of the baby-making kind. Now, all the parties rely, one way or another, on very, very fast growth to pay for their ludicrous spending policies. Now, this isn't going to happen. And we know it isn't going to happen because there is an increasing body of evidence that shows to us, I'd almost go as far to say, as proves to us, that GDP growth is very, very strongly influenced by the number of people in each age group that live in any given country. So in the UK, for example, we think that GDP growth of between 2 and 4% is completely normal because that's what we've had for the whole post-war period. Every time it dips, it comes back again. So we think that 4% is entirely achievable. But if you look at our demographic profile and look at demographic profiles elsewhere and look at what happens, you will see that this simply isn't true. Now look at post-war births in the UK. This is very important. Between 1946 and 1970, births rose by about 15%. That gave us an extra 3 million babies. That's about the current population as Wales. So that is an awful lot of babies. Nice for families, also absolutely brilliant for the economy, because those babies grew up to create what we now call the growth supercycle. They reached their peak spending age at about 46 is the average peak spending age. So as those people reached that age, we had this amazing period, 1982 to 2007, when they spent. And the credit markets at the same time developed to give them money to spend. So they borrowed and they spent. Now the early part of the period in which they spend, up to about age 39, they're working very hard, they're working very productively, they're investing in housing. We all saw this happen. When they hit 40 odd, they get slightly less productive, they move into saving, into other assets, bonds, equities, etc. And that's where you see your wonderful asset price booms, which a lot of you here will have benefited from today. Then at 65, what happens? They stop working, they start drawing down on their assets, and they stop accumulating. You know, think about asking your parents, asking your granny, asking your parents, what do they want for Christmas? What do you want for Christmas, granny? What do you want for Christmas, mum? The answer is just you, darling, just you. Now that's lovely, absolutely lovely, again, nice for families, but really, really rubbish for a consumption-based economy like ours. Old people, disaster. Right. Now, we are doing our best, my generation of working mothers, to keep the show on the road. But, you know, we can't really have more than 2 kids each. It doesn't work like that. Births from 1971 on, that following 25 years, down by 17%. So back to the pre-war level. And there's something else happening here as well. Single households. Last year, the US passed a really amazing and quite scary milestone. 50% of the population was single. 20% of women over 40 in America now don't have children and probably never will. And that's a dynamic that's happening in other places. It's happening in Italy, it's happening in Japan, and it's beginning to happen here. Now the result is that the over 55s are the only age cohort in the UK that are actually growing. Now that's brilliant for tourism, which is pretty much the only thing the over 55s really spend on. It's brilliant for the Money Week cruise. Who's coming on the Money Week cruise? Yeah? Brilliant for that, packed out, but again, absolutely useless for GDP. Now, a lot of you think this is nonsense. I know you do. A lot of people think demographics is nonsense, but you only have to look over to Japan. I have another chart for this, I think. Okay, here we go. This shows, it's not just us, shows all the countries where this is happening. Look at those baby boomers. Spend, 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 age, stop spending. So in the next 20 years or so, there's a huge change coming. Now, we saw this happen in Japan because they came to this whole thing slightly earlier than we did. Their boomers hit their peak wealth-creating age between 1977 and 1994. The Nikkei then peaked in 1899 with government bond yields at 8% and growth at 4%, and since then almost nothing has happened. Regardless of any stimulus efforts, no one has managed to get growth in Japan above about 1% a year. Now, the governor of the Bank of Japan gave a talk on this a few years ago where he warned us that it was going to happen to us. The implications, he said, are profound. There will be differences in timing, there will be differences in magnitude, but eventually all developed countries should expect a decline in growth potential. This chart, by the way, comes from one of my regular interviewees and analysts called Paul Hodges. I've never knowingly made one of my own graphs, and this is carefully nicked from his newsletters. And I actually have a very good interview with him on our website at the moment if you want to hear more from him. He is absolutely brilliant. And so there you have it, a decline in growth potential across the developed world, which doesn't sit very well with the manifesto promises that you've been seeing, which are very, very low on any way to deal with this. Now, outside our local church, you all will know I live in Edinburgh, our local church just down the road has a sign outside it, and on that sign it puts inspirational quotes. You probably all have churches exactly the same, right? This is the one outside my church at the moment. Now, any politicians who come to Scotland have to drive past our church on their way from the Scottish Parliament to the airport. And I have a horrible, horrible feeling that they are taking this rather too literally as a solution to the UK's problems. Now, one thing that I think that our politicians have finally noticed, and this is vital, they've noticed there's a mild demographic problem, and they've noticed that they can't solve it in the way that they would like to. So they've resorted to printing something else instead. Money. If you can't print babies, you have to have a go at something else to get the economy growing. And they believe, or appear to believe, that the answer is to print lots and lots and lots of money. But here's the thing. It isn't working. Because in the end, monetary policy comes up against demographic reality time after time after time. If you have a demand to deficit, if you have old ladies across the world going, just you, darling, just you, you can't get an economy growing. So we've thrown everything, including the kitchen sink, at Western economies over the last couple of years, and growth is still absolutely pathetic. What we have ended up with, instead of economic growth, is hugely financially engineered markets of the kind we have really never seen before. A market in America that is held up almost entirely by super low interest rates, by the buybacks that are financed by those interest rates, and nothing else. So, here are the things that we know. We know that demography is killing growth. We know that governments don't understand that demography is killing growth. And we know that instead of proper policies, they were giving us super low interest rates instead. And we know that QE, part of that monetary policy, gives us asset bubbles. But here's the thing that I think most people don't know yet. The next step. QE doesn't give us inflation, it gives us deflation. Now, I've got another slide for this. People find it very hard to grasp, so I've written it in very big capital letters. This is a bit like shouting at foreigners. You'll understand it better with the capital letters. How does this work? Super, super cheap money means that businesses that should go out of business do not go out of business. You can see that in the junk bond market. You can see it all over the corporate bond market. I think James Ferguson talked about this earlier. If anyone can get money, nobody goes bust when they should, and then you have oversupply. You have oversupply going into a market with excess demand. What do you get? You get deflation. Then you have central bankers looking at that and going, oh my God, we have deflation, we must print some more money. So they print some more money, it starts a whole new cycle of capital misallocation and excess supply. Brilliant. Print money to get inflation, get deflation, panic, print more money. And that appears to be about the size of current government policy. Now, in the end, governments get what they want because they control money. So in the end, this deflation will give way to inflation. There will be a crossover point after which the misallocation of supply is beaten. The oversupply of products and goods is beaten by the oversupply of money. I can't tell you exactly when that crossover point comes, but come it will. And you only have to look at Russia to see how that happens. There is definite deficiency of demand, but there is also definite inflation. The Russians have been printing money like there is no tomorrow. They have inflation at 17% and rising. The week before last, inflation was 0.1%. Last week, it was 0.2%. 0.2%. So it happens in the end. There's also a possibility that our governments will hurry it along a little by changing the way that they use their printed money. At the moment, our new money goes entirely into the financial market. So you see the wonderful asset bubbles that I think we have all enjoyed so much. But there will come a time when they realize that doesn't work, and the money will start going directly into the economy, into the consumer economy, directly into infrastructure projects, things like that. And that, I think, will be the signal that it is time to shift from a deflationary mindset as investors into an inflationary mindset. Now, I've put this one in just because it's really fun on the nature of money. This is from the same 1963 Statist magazine. It's an ad on the opposite page to the thing I just showed you. Don't open it, it's money. And it's about these packets of silver that circulated in Japan many hundred years ago. The silver is inside the packet. No one ever opens the packet because they trust that inside it is the silver. Until, of course, one day someone opens it and finds out that the silver isn't there. And that's what's going to happen when we flick from deflation to inflation. And we want to be ready for that. I think when James Ferguson was speaking this morning, and he makes a point of always doing this when he's speaking on the same stage as me, of telling you that gold is a rubbish investment and you shouldn't go anywhere near it and no one should hold gold. Did James say that? Yeah. He did. He's wrong, absolutely wrong, of course, that gold is not an investment, it's an insurance. I still hold it, and I still think everyone should be holding a little gold against the possibility, or actually the almost certainty, of this shift from deflation to inflation. Okay, right, let me check out a couple of investment ideas. I've got to live up slightly to the title of this presentation. First, onto the election results, which is what I think I said I'd speak about initially. What do you need to worry about from an investment point of view, and what do you not need to worry about? If it's a Conservative majority, I suspect you might think that you can all relax a little, but of course you can't, because if that moves on to a referendum on Europe, you'll get massive sterling volatility, you'll get another referendum in Scotland, and then of course you'll get the gilt crisis that comes with that, because the markets aren't going to look kindly at a second Scottish referendum. So you might want to open a foreign currency bank account. If there's a Labour majority, you might think you can relax a little bit because there'll be a short period of stability, but you don't want to do that because you will lose a lot of money over the long run, partially because of tax. There'll be the mansion tax, which will start out on non-mansions and move down to sheds before you know it. The 50% rate will be back. The threshold on that, I think, will fall very quickly. If you're rich at £150,000 a year, why aren't you rich at 120, and why aren't you rich at 100, 90, 80, 70, 60, 50? That 50% is going to fall very fast. Then, of course, your actual investments will be hit. Markets don't like anti-market and anti-business rhetoric. I don't either, but you're going to get it. Miliband has been very vocal in how he feels about price caps on the utilities. You don't want to hold them. On his loathing of the banks, expect fines and levies to go up. You don't want to hold them. And of course, there'll be more punitive taxes and fines on sectors that people just don't like tobacco. I don't like tobacco either. You don't want to hold those. If you have a Labour win, what you get is a huge new level of political risk around all stock market investing, and that's something you are going to want to watch out for. You also have to worry about a gilt crisis as well, because if lack of confidence in our deficit and one day maybe our debt reduction falls, then we will have the gilt crisis we have been waiting for. Again, you might want to open a foreign currency bank account. What else? Coalitions. You might have a Labour SNP coalition. It barely seems worth going through that. You might want to open a foreign currency bank account. Now, whoever wins, if you're well off, you're also going to find there will be more changes to pensions. Who earns more than £150,000? Oh, come on, don't be so coy. I know there's more of you. Come on, hands up high. We're capitalists here. Be proud. Okay, all of you, I hope your pensions are full. Because after this election, there will be major cuts to the tax relief available to anyone earning over 150, 140, 130, 120, 190, 80, 60, 50, down we will go. So if you have money to put into your pensions, do it very, very fast. Okay. Where do you invest? This is really tricky. Gold, as I said, is not an investment, but I was writing this week about bubbles in the FT, in my FT column. Bubbles I'd really, really like to go back to. You know, the great dream of every stock market investor is to go back to the beginning of a bubble with perfect knowledge. And if I were to go back to the beginning of a bubble, this is a tough choice actually, there are lots of really fabulous bubbles, but if I were going to go back, the bubble I'd really like to be in on the beginning of is the Japanese bubble, which was amazing. Now, I'd like to arrive there in the 1950s. I'd like to arrive there in the 1950s because I'd like to live somewhere that grew that fast. Amazing exporting machine, kicked off in the 50s. They got back to pre-war levels of GDP by 1955. This is stunning, stunning. And then into all of the 60s, Japan grew at about 8–9% a year, with some unbelievable years, 1959 to 1961, where it grew at over 15% a year for 3 years in a row. This is absolutely stunning stuff. Now, there were worries. It wasn't all easy going. The governor of the Bank of Japan at the time, Masamichi Yamagiwa, he wrote a note where he fussed over all sorts of things. He was fussed about overcapacity in steel and iron. He was fussed about lack of infrastructure spending. It seems crazy now, but there was a time when Japan didn't have enough railways. He fussed about trade liberalization. They were terrified of free trade in Japan, still are. But nonetheless, it grew and grew and grew. I have a chart for this. There you go. Real GDP growth in Japan. But here's the really interesting thing. For the purposes of getting rich, which is all we care about, right? This bit, the 50s and the 60s, with this amazing growth, is irrelevant. Nothing happened at all in the stock market. If you look at a chart of it, you'll see a very slow, gradual rise. Then here in the 70s, this is when stuff really started happening. This is when growth really slowed. Into the 1970s, growth fell down to about 4%. The early years of the 70s were absolutely awful. There was a nasty slump, endless, miserable soul-searching about what should be done about the Japanese economy, how it could rebalance, how it could open itself to more trade, how it could liberalize, how they could drive domestic demand, etc. They didn't do any of these things, of course, but the conversation was there. That went on into the early 80s as well. But what happened was that the stock market went berserk. Up fourfold in the 70s, up tenfold in the 1980s. And in a demonstration of just how mad markets can go, when NTT, the telecoms company, listed in, 1987. Anyone working the Japanese markets remember that? I mean, this was amazing. It came on at a PE of 270 times, making NTT, one company, worth more than the entire German stock exchange. Now imagine how the Germans felt about that, right? Now, you'll be wondering why this happened. Why is it that the market didn't start to move until growth began to collapse? Now, there are a couple of things here. There's been a lot of studies into the connections between stock market growth and GDP growth, and we always find there's very little correlation. That's partly because during these expansionary phases, there's very little money to spare. It's all spent on the expansion. So the real money comes after the expansion. The profits start pouring through. Also, the arrival of the institutions. Foreign fund managers were very, very underweight Japan in the 60s. Come the 70s, come particularly the 80s, they arrived in volume. By the mid-80s, you couldn't get to a bar in Roppongi for all fighting through all the foreign fund managers. But there was more than this. It was also about monetary policy. In a nutshell, what happened was that in 1971, the Bank of Japan grotesquely overreacted to the US suspension of the gold standard by, you guessed it, printing money. Printing lots and lots and lots of money. So regardless of the recession, regardless of anything, the economy didn't take off, but the stock market did. Same happened in the 1980s. There's an excellent book on this by Richard Werner, Prince of the Yen, and in it he says, Japan printed money and bought the world. And that is exactly what happened. Now, that brings me to China, where pretty much exactly the same is happening. Growth is collapsing, 10% down to below 5%, maybe further down. Stock market has doubled in a year into that collapse. Foreigners are hugely underweight the market, despite it representing the second largest economy in the world. There's a program of liberalization underway, and the Chinese are printing money like there is no tomorrow. So how's that for rhyming history? Now, you will say that China is completely different. You will say that its economy is a debt-ridden disaster. You will say that its corporate governance is appalling. But this was exactly the case in Japan in the 70s. Its economy was a disaster, and its corporate governance was appalling. No dividends, no buybacks, no independent directors, none of that muck. Still don't today. Japan managed to have one of the most fabulous stock market bubbles of all time, with not even the slightest nod to shareholder value, or indeed to any value at all. And China could do exactly the same. Now, I am not suggesting that you invest too heavily in the Chinese stock market. Anything that's gone up 100% in a year and where 1 million new accounts are opened every 2 days is something you need to view with an itsy-weeny bit of suspicion. But I do think that if China goes anything like Japan has and you can cope with the volatility, there's another 800% to go. Worth thinking about. Now, I hold China on my own set via the Fidelity China Special Situations Fund, which I've written terrible things about in the past, but is beginning to come good. What else? Japan, I would definitely still stick with Japan. Corporate governance actually is finally beginning to improve a little bit, and of course, it is still all about the money. Annualized base money in Japan is up 40%. And that's enough to keep this asset boom going. I would get into Japan these days via the residential property sector. Residential property in Japan is still remarkably cheap by global standards, but it's just beginning to be bought up. And also, Abenomics includes a plan to buy up real estate investment trusts listed on the Japanese market in order to boost the sector as a whole. Now, you don't want to buy any of those trusts because they are already trading at 40–45% premiums. But there is a UK-listed trust, the Japanese Residential Investment Company, that does something remarkably similar. Obviously, it's not going to be bought up in any of the QQE programs because it's not Japan listed, but it does have massive exposure to a sector that the government of Japan has explicitly said that it intends to ramp. It is not trading at a discount, it's trading at about fair value at the moment, but it does remarkably come with a yield of about 5%. So I think that's quite interesting. Otherwise, I would keep looking at small companies. I think when I last spoke here, I said that if I was going to be investing heavily in anything, it certainly wouldn't be in big companies because of the political risk. It would be in smaller companies because all politicians love smaller companies. Did any of you invest in Neil Woodford's Patient Capital? Yeah. New investment trust, £800 million raised in a matter of weeks. I had breakfast with him the day before yesterday, and we talked about how long it's going to take him to invest, and the answer is about 3 years. So you're going to be waiting 3 years for that money to be invested, and while you're waiting, the trust that you're in is trading at a premium. Now, I'm not saying that's not going to come good, because I think there's every chance that it will. Neil is a fabulous fund manager, and I'm sure he knows what he's doing. However, if you want to be in the smaller cap space in companies that have already actually invested the money, where you're not paying for someone to hold cash for you, you might want to have a look at the Artemis Alpha Trust, which is trading at a 20% discount and has a huge variety of interesting little companies knocking around in it. I think it trades at something of a discount because people believe it to be a resources trust, but as I understand at the moment, it's about 12–15% in resources, so that's not all of it, and it's trading on a very nice discount. Okay, I think I will stop there. I see that my time is up, but I want to leave you with the memory that markets are not normal. It is very easy in times like this, when markets appear to have forgotten about the financial crisis, to believe that that crisis is over and to forget exactly how manipulated our markets are. Brains find it much easier to believe than not to believe. You look at studies on belief, you will find that believing is easy, not believing is hard. This is why toddlers are so unbelievably credulous. And of course, why there are many, many more delusions than the academics at Cardiff will ever let you know. So I'm going to leave you with a final delusion. Delusion. Thank you.